In this video, we are going to look at a dangerous trade idea in the British pound versus the Japanese yen. I want you to pay attention to this trade because it's a good example of something that you should not do, or at least something you should approach very carefully. I'm saying this because a dangerous idea can turn out to be a profitable trade, which just makes the idea even more dangerous. This particular trade is also a little more dangerous because it is on a high time frame, so the stops will be larger, and the trade will take longer to complete. This has some effects in the psychology of a trader. The essential point here is that if you don't have an almost perfect reason to enter a trade like this, just don't do it. There are plenty of other easier opportunities to take in the market, and they are quite frequent also, so there is no point concentrating on danger. From number 1 to number 11, we see the pound-yen creating higher highs and higher lows in a pretty well-organized fashion. There are some scary candles like number 6 for example, but nothing in this market is telling us it will give us a short trade opportunity. If anything, you should be looking for opportunities to go long in this market. Newtonian physics tells us that there must be an external force to stop the momentum of this trend. At the moment, it has its own inertia and there is no rule that tells us that it should not continue to go up much higher. Observe that I drew several horizontal blue lines in the chart representing the turning points between market vectors. Notice how perfectly the market lands on these turning point lines in number 6 and in number 8. Also notice that in number 10, the market didn't landed on the turning point line drawn between market vectors 7 through 9, but it landed on the support and resistance line that comes out of number 7. Number 6 and number 8 are valid long trade opportunities because we have the context of a stair-stepping market landing on a turning point line with a fractal candle to nail the coffin. As I told you before, I want to show you the dangerous idea here. Those trades in number 6 and number 8 are just perfect ideas, and there is nothing challenging about them. Another thing I want to show you here is that up-sloping red line that was drawn from number 2 to number 4 connecting several low tails together. Look at how perfectly the market goes back to that line a few times after that in number 6 and number 8. There are 13 candle tails touching that line, which makes it a quite powerful line to use in a context. However, that's a subject for another day. Let's bring the attention back to our irresponsible trade. Observe that in number 11, we are experiencing a simple reversal divergence marked by the short blue lines between 9 and 11. That's not a big deal because we also have a simple reversal divergence between 7 and 9. This is where traders start to give up on the idea of divergence, and with good reason because the relative strength index will produce a series of bad signals and traders will get burned time after time. However, if you are aware of fractal divergence, you can control this idea more precisely. If you were to go short somewhere around 9, you would at least wait for a fractal candle to appear, so you would not feel so reckless taking a short trade in a clear up-trending market. Notice that fractal candle 9 produces a quite nice pullback to number 10. However, as it is usually said, the devil is in the details here. Let's look at the attributes of candle 9. It's relatively the same volatility as the previous candles. It has a small body and large tails. If we try to roll back the chain of causality of that candle, we will arrive at the conclusion that there was some internal fight between buyers and sellers, and that the winner of that battle didn't really win by a large margin. The candle has a bearish quality to it, but as you can see, it's not that strong. By looking at these details you can see how going short in candle 9 would not be the best idea ever, but you could get away with it due to the precision of the fractal candle. Candle 11 is a similar situation momentum-wise, but the candle itself tells a completely different story. Candle 11 is a fractal candle as you can see by the short red line in price and in the relative strength index. Beyond that, look at the attributes of the candle itself. It has a higher volatility than the previous candles. It is an outside candle, which means it is fully encapsulating the last candle. The logic behind that outside candle quality is that the dominant player in candle 11, which were the sellers, were not only strong enough to stop the buyers from bringing the market up, but they were strong enough to create a lower low than the previous candle. Look at the upper tail of candle 11. It implies there were some buyers up there, but they clearly got smashed down. Now look at the downward tail. It barely exists. This shows a kind of certainty of the sellers in this case, not to mention the large bearish body of the candle. If we compare candle 11 interpretation with the candle 9 interpretation, we will notice that they are quite different. The short trade you see in this chart was triggered because of the candle attributes of candle 11 in comparison to candle 9, plus the second-degree fractal momentum divergence we have here. However, this is clearly going against the main trend of this market as far as we can see up to this point. This is why I'm warning you that you might get away with this stuff once in a while, but it is usually a bad idea to go against the trend. However, there is nothing impeding candle 11 to be the beginning of a downward movement. It's just not very wise to look for the absolute market reversals like that. Trading is already pretty difficult with the relatively easier contexts. The only possible logical place to put a stop loss in this trade is a few pips above the high of fractal candle 11, because if this is indeed a good fractal candle, the market will not spike its high, and it will produce at least a reasonable retracement down. The target can be placed anywhere where buyers might show up, as long as it gives us a good risk-reward ratio. I just placed the target in the turning point line between market vectors 1 and 3. Let's see what happens next. This is a situation where we have to be very careful because a trade like this can easily trigger a trader's overconfidence bias, which will inevitably lead to disaster. I hope you are able to see the bigger lesson here, and understand the heavy temptations that are attached to this kind of trade. I hope that you also learn to resist these heavy temptations. This was a 270 pip trade in the 4-hour timeframe. Just imagine how satisfying that can feel. Remember that this feeling of satisfaction has a rotten and malicious nature underneath it, and it will attack you in the first chance it gets. I'm showing you this, so you don't have to go through this experience yourself. Some say that wise people learn from the mistakes of others, so I hope this serves as an inspiration to you.